Hey everybody, it is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, April 18th, 2026. Hey, how you doing? I hope you had a good trading week. We had a big week for the bulls, and that was a nice change of pace compared to what we've had over the last month and a half. So it was a great week for me. I really hope it was a great week for you as well. And thanks a lot for coming and spending time and watching my weekend review podcast. I hope it is going to be helpful. So the format for today's podcast is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the positions, all the trades that I made last week. We're going to talk about when I entered the trade, why I entered the trade, what the signal was, or what the confluences of signals were, how I am going to position size based upon the current volatility of the market, how I'm going to place my emergency stop, how I'm going to place my end of bar stop, how I'm going to take partial profits if the market starts to move my way, what I'm going to do when I get to trailing stop level, and then ultimately, if it gets to significant overhead resistance levels, how I am going to completely exit the trade. So I have some really good trades this week with different strategies that I can show you good examples of when I enter the trade, why I enter the trade, and how I am managing it going forward. You know, it's very important, extremely important when you trade, in my opinion, that you have a process to follow. So you definitely know when you're in, you definitely know what you're out. It takes a lot of stress off you. It's a lot more holistic way to trade just to have a process-driven trading approach. And that is how I trade, and that is what I teach in my trading as well, is a very good process-driven trading strategy. So after we take a look at my trades, we are going to talk a little bit about trader psychology. It is the most important skill in trading, the ability to create a plan and to follow it. It sounds easy, but it is not. But really, when you have a good trade and you structure a good trade, getting out quickly when you're wrong is the right thing to do. But staying in, even when it's going up a lot, having a process to tell you, hey, I'm in, yeah, it's going up a lot, but I'm not supposed to do anything, so I don't do anything. That is how you get these large outsized gains that will ultimately pay for all the inevitable losses and hopefully small losses that you have. But you know, the whole thing about trading and having a trading um, with trading psychology is having a plan to follow, so it takes the stress off of you and you just follow what your plan is. So it's always helpful for me to teach trading psychology, and I hope it's going to be helpful for you to hear. After that, I have gone down through my master watch list. I did it last night, and I'm looking at some potential trades for the upcoming week. Now, these trades are not where they need to be, but they're getting close. And what I'm looking at in this weekend's potential setups for next week is that I'm looking for these particular markets. They're coming down into some significant support levels, multiple confluence of support levels, RSI levels, order block levels, major moving average levels, the MACD bullish divergence levels, and I'll be pointing out to you exactly what I'm looking for, what levels I'm looking to have rejected before I enter, and then we'll talk about position sizing, emergency stops, end of bar stops, taking partial profits, trailing stop mode, and like I said before, completely exiting your position. So these positions are not where they need to be, but they're getting closer, within striking distance. And so hopefully this is a good opportunity for you to take a look at how I look at trading, how I look at these levels, and what levels I'm looking for to be rejected so that I could potentially enter the trade. So if anything you find in the podcast today is helpful for you, I really would appreciate it if you could hit the thumbs up button. It just takes a second, totally free, and lets YouTube know that there's some valuable content here. So, and if you're not a subscriber, if you could subscribe, that would be fantastic as well. Thank you very much for that. So let's go ahead, run this U.S. legal disclaimer, get that out of the way, and then we'll come back and we'll take a look at the positions. So hang tight. Thanks.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding on with me, and let's get started on AMD. AMD has been a monster trade, one of the biggest trades I've had in probably a couple years. I mean, this was some kind of week, but this is a good example of a very good confluence. It started with a confluence of two major signals with a very, very good risk to reward ratio that just took off. I bought it down here at 196.10, and you can see this has just been a monster. But let me point out two things to you here on this particular trade. The first is the 200-day moving average. This is the black line. This is a major moving average. Large financial institutions, savvy traders, key off of this particular level. And you can also see the green box here. This is called an order block, and I'll explain what an order block is in a minute. But an order block to me is a smart money area. So we have a two key levels. We have a smart money area in the order block, and then we have a key level of the major moving average to give us our line in the sand. We're in above, we're out below. So let me explain to you what an order block is. And this order block was formed in the past. So let's go back to the past, and I'll show you why I entered based upon this order block. This order block started all the way back here on 11/25/25. So the trade that I took recently was based upon this bar. So let's talk about why this bar is so important. So an order block, the pattern for an order block is it starts with a swing low. A swing low is simply a low that has a higher low to the left and also has a higher low to the right. This is a swing low. It's this little pivot point. So in order to create an order block, or for there to be a valid order block, the way that I trade order blocks is first I need a swing low. Then I need a swing high. Now a swing high is just the opposite of a swing low. A swing high is a high that has a high with a lower high to the left and a lower high to the right. So now we have a swing low and we have a swing high. The next thing I need is another swing low that's lower than the first swing low. And this is it here. This is a swing low, right? Higher low to the left, higher low to the right. Just like this first, higher low to the left, higher low to the right. But the key is this particular low was lower than the first. So again, we need a swing low, followed by a swing high, followed by a lower swing low. And once we have that in place, now I have to go back to that first swing high. And if after I have a swing low, swing high, lower swing low, if the price can move above that swing high, now we can define the order block. We have changed market structure. We have changed market structure from bearish to bullish as soon as we have this in place. Swing low, swing high, lower swing low, and then we take out that swing high. So as soon as we take out that swing high, now I can define my order block. And my order block is the lowest closing bar prior to the market structure change. So on this particular day here, the market structure change, and I take the high and the low of the lowest closing bar before market structure change, the high and the low, and I bring this into the future. So when you change market structure to the upside, or in other words, you go into an uptrend, buying dips back in this order block is the correct way of using order blocks. And just here you can see swing low, swing high, lower swing low, market structure change. Was the dip back to the order block a good idea? Yeah, it was. Was the dip back to the order block a good idea? Yeah, because it went up. So this is the key level that I'm looking for the markets to come back to. So, for example, if you took this trade here and then you're all the way up here, can I, in hindsight, go back and say, hey, smart money was buying in this area? Well, for sure. I mean, look, was it smart money buying here when it goes up here? Yes. Smart money buying here when it goes up here? For sure. So this is my smart money area. Anytime it gets back into this area, this is where I want to potentially be looking to buy. So if we take this into the future, again, this is the order block from the past. You can see any place in here was pretty good spot to buy. But what I really like to do with my trading is I like to look for confluences, not just one signal, but two. So the first signal is we have this order block back from the past that I just showed you, but inside of this order block is living a 200-day moving average. So this, for me, this is a combination of an order block trade and a deep dip buy signal. The deep dip buy signal, the way that I use and I teach deep dip buy signal involves the 200-day moving average, the 250-day moving average, the 300-day moving average, or the 30 RSI, a rejection of the 30 RSI. So on this particular trade, this 200-day moving average is inside the order block. Now, just buying a rejection of the 200-day moving average is valid by itself. There's no doubt about that, but your chances, my chances, are dramatically, just in my experience, are dramatically improved when I have this moving average inside of the bullish order block. So I did enter AMD here on the 30th of March at 196.10 because on this particular day we went below the 200 during the day and then we closed above the 200 at the end of the day. So that's my signal. So let's start with, I have the signal, I have the rejection of the 200-day moving average inside of the order block, and okay, I want to buy that. How many shares am I going to buy? So this is very key. I always tell this to other traders and to my students. Look, the most important decision you can make is how many shares of something are you going to buy? And I use a very simple formula that uses two inputs. The first input is how much money is in my trading account, and the second input is what is the current market volatility of the market. And so the market volatility. And so the first thing, let's just say I have a $100,000 trading account. All I do is I take 1% of that. 1% of 100,000 is $1,000. If it was 200,000, it would be 2,000. Million, it would be 10,000. 50,000, 500, right? So $100,000 times 1% is $1,000. Then to find out the volatility of the market, I look for the average true range times 2, the 2 ATR. This is twice the average daily range. And at the moment, this number is 20.95. And so if I take my maximum allowed loss on any one trade, which is 1% of my trading account, and divide it by the value of the 2 ATR, that tells me exactly how many shares to buy based upon how much I have in my trading account and what the market volatility is. So if I take 1,000 divided by 20.95, tells me to buy 47.7 shares. So I would just round that up to 48 shares. So when volatility is very high, this number is larger. And when this number is larger and I divide it into my maximum allowed loss, which is $1,000, it's going to have me buying fewer shares. If market volatility is low and this number is low, then it's going to have me buy more shares. And that's very important. When market volatility is high, you should be buying fewer shares because the volatility is higher and vice versa. All right. So that is how many, as far as for me looking how many shares I'm going to buy, 1% of my total trading account divided by the value of the 2 ATR on the day of the trade tells me how many shares to buy. Okay, let's just say I buy 48 shares. Okay, so I entered here on the 3rd at 196.10, bought my 48 shares. Now, what's the first thing that I do? The first thing that I do is I take my entry price minus the value of that 2 ATR, and I place my thick red line here. This is my emergency stop. If my 48 shares moves $20.95, how much have I lost? $1,000, right? That is how much I am able to risk on this particular trade, 1% of my total trading account. Okay, if it ever gets down there, I've got to sell. I've lost $1,000. But the good news is Well, first I should say you need to have an emergency stop, right? Because not everything goes to plan. Sometimes things go against you, and there's a certain point where you just have to go, that's it, I'm done. I've lost 1% of my account. It's not fun, but I can recover from it. So I don't want to let it get more than 1%. So that's why I have the emergency stop down there. But I also use what is called an end of bar stop. And the good news about the emergency stop is that, yes, I hit these, but only about 5% of my trades. Only about 5% of the time will I hit an emergency stop. The other 95% of the time, if I have a losing trade, it will be not because of my emergency stop, but my end of bar stop. And my end of bar stop, if I've done a good job with my entering, is very, very close to where my entry point is. So if I'm wrong, I can be wrong quite small. And if I'm right, I can have the potential for a very big trade. So I bought the rejection of the 200-day moving average inside the order block. I position size like I just showed you. I placed my emergency stop 2 ATRs below me. If it gets there, I lose 1% of my account. My end of bar stop is simply a close below the black line, below the 200-day moving average, because that's why I entered the trade in the first place. On the day that I took it, it rejected it, went below it during the day, and then closed back above. Where is my end of bar stop on this? Simply a close back below the 200-day moving average. Even a penny, my rules would tell me that I have to get out. All right. But the structure is there. I was patient. I waited for a confluence of signals, rejection of the 200-day moving average inside the order block. I position size, place the emergency stop. My end of bar stop, like I said, simply a close below the 200-day moving average. Now, the next thing that I do, once I know where once I position size, I've position size, I've entered emergency stop, end of bar stop. The very next thing I do now is I look to the value of the 1.5 ATR. And right now, today, it is the value of the 1.5 ATR is $15.71. So as soon as I know where my emergency stop is, I know where my end of bar stop is, I take my entry price plus the value of the 1.5 ATRs and I place it above my entry. So this is my trailing stop level. Once I take the trade, if it moves up to the trailing stop level, I don't do anything. It's just that if it crosses that threshold, now I am in what is called trailing stop mode. So trailing stop mode just means now that I've touched the trailing stop level line, in the future, if I have a close below a previous bar's low, I am going to exit half of the position. And in trading, when you enter a trade and it starts moving nicely your way, you've probably heard this, right? That you want to tighten up your stops. And this is what the trailing stop level does for me. If it gets to my trailing stop level, now in the future, if I have a close below a previous bar's low, I am going to exit half. It doesn't change where my original emergency stop or where my end of bar stop is, but the fact that I take off half has the effect of moving everything up, right? Because now I have half the shares. So just by default, it moves all of my stops up. So it's really a great way. I've been using this for over 30 years and it's worked really, really well for me. So again, I entered here 196.10. I placed my trailing stop level 1.5 ATRs above. Once I get to trailing stop level, if I have a close below a previous bar's low, I will exit half of the remaining shares that I have. Okay, so everything we have talked about so far, as far as emergency stops, end of bar stops, trailing stop levels, these are all defensive moves. Or in other words, if the market moves against me in any particular way, I'm going to have to take defensive action by getting out, right? But I don't like just to play defense in trading. I like to play offense, meaning that I like to take a certain percentage of my shares off each day if they move a certain amount from the previous bar's close. So I like to play offense and defense. I like to sell into strength. And it just kind of makes sense. Like I can't, for me to trade any other way, it just really doesn't make any sense. Right? It just, right? In my gut, it just makes sense. That is the correct thing to do. So I do this every day. I set profit targets every day for a percentage of my shares. Not all, but just a percentage. But so I'm still in AMD here. So let me show you how I place my profit targets for Monday in this case. I always set 3 profit targets every single day uh, for the next day. So for Monday. So let me show you exactly how I do that. It's very simple. I just take the closing price of the day. The closing price of the day is 278.39. So I just take 278.39. And then I look for the value of the 0.45 ATR. Right now, the value of the 0.45 ATR is $4.71. So I just take 471 plus the 278.39. Now my first profit target for Monday is 283.10. So I'll just put the line up here, 283.10. There's my first profit target for Monday. Closing price plus the value of the 1.5 ATR is 283.10. Now I place 3 profit targets. So to find my second profit target, I just take my first profit target, 283.10, and again, I look for the value of the 0.45 ATR. Again, it's 471. I take the first profit target, 283.10 plus 4.71. My second profit target for Monday is 287.81. And then I'm just going to do it one more time to find my third profit target. I take the second profit target of 287.81 plus 471. My third profit target for Monday is 292.52. 292.52. There we go. So those are my 3 profit targets for Monday. Look, if it goes down on Monday, I'm not going to hit any profit targets, right? But if it goes up decently, maybe I hit 1 profit target. If it goes up really nice, I hit 2. If it goes up great, I hit 3. But there's a lot of advantages to these profit targets. Multiple. One, you're taking off and locking in gains at a higher price when the market's giving to them the gains to you. Secondly, it's reducing your position size into strength. And one of the advantages of having a reduced position size is the lower and lower and lower your position size gets, the more likely you are to follow your trading process, which is ultimately the only way to make money long run. So, just little tricks and tips as far as at least for me and my psychology. I just love taking little profits, not all, just little, and it just helps me to follow my process, which I know is a good process. So again, Monday, if I hit a profit target, how much am I going to take off? It's very simple. However many shares I go into the day with, I take 10% off at each profit target. So if I went into the day with 20 shares, I would take 2 off at the first profit target, 2 off at the second, 2 off at the third, right? Maybe I hit 1, then it reverses down, and then I have to redo those 3 profit targets for the very next day. It does take some time. I just put them in as limit orders in for the next day. It does take some time, but it's well worth it. That money adds up, really adds up over the days, months, and years of taking those partial profits. And if it moves back down for whatever reason, you are really glad that you sold into that strength. Okay, so that's kind of the basics of everything. And now let's just kind of go through it now again, and we'll follow the trade and see how we did. So again, I entered AMD here on March 30th at 196.10. I position sized. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 200-day moving average, giving me a very good starting risk to reward. I place my trailing stop level 1.5 ATRs above. That is the orange line there. And the next day, great, starts, goes my way. Perfect. I hit a profit target on that move up. The next day, up again. Hit 2 profit targets into that strength, and on this particular day, also got to the orange line, also got to trailing stop level. Doesn't mean I do anything. It just means now in the future, if I have a close below previous bar's low, I'm going to get out of half. Next day started down, but rallied back up, perfect. Took another profit target into that strength. The next day, up again, perfect. Took profits into that strength. Next day, up a little, but not enough for any profit targets whatsoever. The next day, really moved up strong. Again, sold into that strength. The next day, up, profit target. Next day, up, multiple profit target. Next day, nothing. Next day, profit target. Next day, profit target. Thursday, 3 profit targets on this particular day. And then today, it was up a little, but not enough for a profit target. So when I enter a trade and it starts moving up nicely, obviously like this one is, there are 2 key levels that I'm looking at based upon the RSI. The first one is the 65 RSI. If I get to a 65 RSI or higher, and then I close below the 5 EMA, which is this blue line here, that's the end of my trade. You can see we're still above the 5 EMA, so that doesn't come into play. The other level would be the 70 RSI. If I go up and reject the 70 RSI, I take off half of my shares. And then after that, if I have a close below a previous bar's low after reaching the 70 RSI, rejecting the 70 RSI, that's when I completely exit the trade. So if I go into trailing stop mode and then I have a close below previous bar's low, I exit half. If I get to 65 RSI and I close below the 5 EMA, I exit the full trade. If I reject the 70 RSI, I sell half. And then after rejecting the 70 RSI, if I have another close below previous bar's low after rejecting the 70 RSI, I get out of the trade. Well, this trade has done none of this. I'm in trailing stop mode still, but it has just kept motoring up and up and up. It hasn't rejected the 70 RSI. It hasn't closed below the 5 EMA. So at this point, if I have a close below previous bar's low, I will exit half because remember, I am in trailing stop level. If I close below the 5 EMA, that will be the end of the trade. So this is kind of an outlier situation. This doesn't happen very often, but basically next week, if this said close below the 5 EMA, guarantee you I'll be out of this trade. So this particular trade has been a monster. The remaining shares I have on this trade are up 29.48%. But my stops are very tight here. Monday, if we have a close below previous bar's low, I exit half of the remaining shares. And then in the future, close below the 5 EMA, completely out of the trade. But this is a very good example of being patient, waiting for a confluence of signals. All the signals I take are based upon confluences. And again, I entered here 196.10. If the next day it closed below the 200-day moving average, even by penny, I simply would have been out for a very, very small loss. But again, this is a good example of having a good risk to reward ratio and having a process to follow that keeps you in a trade that is moving your way until something happens to where I need to get out, like close below the previous bar's low, getting at half or getting out of the 5 EMA. But yeah, unbelievable trade. The remaining shares up 29.48%. Silver. All right. Silver, a little different type of trade. Kind of a different type. Well, yeah, so one part of it's different, but we talked about order blocks, right? On SLV, there was an order block from the past. That's why I have the green order block in here. Now, on the previous example of AMD, we rejected a moving average inside the order block. But with order blocks, you can enter if you have a rejection of the bottom of the order block, meaning you went below it and then closed back in it, or you closed in it and closed above it, which was a rejection of the top of the order block. That's valid, but I like to have confluences. Well, the confluence, when I took the trade here at 69.80 on the 19th of February, had to do with the bar before. You see the bar before I highlighted in blue. This is what's called a bullish abandoned baby. And the reason that it's called a bullish abandoned baby is the previous day gapped down. For whatever reason, from the close to the open, there was bearish sentiment, right? The price gapped down, which is bearish. However, the very next day, it gapped up. And when you have a very quick change in sentiment from bearish to bullish, creating the abandoned baby. More times than not, when you look out into the future, the price will be higher than it will be lower. Not all the time, but the majority of time, in my experience, when you have these bullish abandoned babies and you look in the future, it is higher. So the confluence of the trade was twofold. One, the previous day we closed in the order block and then we closed above the order block. That is a rejection of the high of the order block, valid by itself. But it the close back above the order block also came with the bullish baby. And so that is why I took the trade. Now, when I take a trade based upon a bullish abandoned baby or bearish abandoned baby, if the case may be, I change up a little bit. I don't have a trailing stop level. I don't take partial profits. This is the only strategy where I change how I manage the trade. I make it very easy. When I enter, I place a 2 ATR. If I'm long, like I am this trade, I place a 2 ATR stop below me. If I get there and hit that, I lose 1% of my account. To the upside, however, I place a 4 ATR profit target. So if I'm right, I'm going to make 2%. So I'm risking 1% to make 2%. And in my experience, I make 2% more than I lose 1%. So it makes sense. So if you have an edge where your winning percentage is higher to make 2% than to lose 1%, it's a pretty good edge, right? So that's what I did. I entered here on the 18th of February at 69.80. I placed my emergency stop 2 ATRs below. I placed my profit target 4 ATRs above, and I'm just letting this trade go. I'm either going to lose 1% if I get down here, or I'm going to make 2% up here. And I'm not taking partial profits, anything. This is just a set it and forget it trade. The trade started off really great and then not so great. We went down, but you can see I did not hit my 2 ATR stop. And since then, we have rallied nicely, and currently the trade is up 5.2%. But again, I'm not taking partial profits, and I'm just going to, whether this take weeks or months, for sure, I'm either going to lose 1% or I'm going to make 2%. So I'll just let it do its thing. One of these two things will happen, and hopefully it will be the 4 ATR. But currently, this position with the combination of the order block and the bullish band of baby is up 5.2%. So pretty good. Microsoft, massive trade. And again, it's a confluence of two different signals. So you can see we have the green box, we have the order block. This is an order block from the past. And again, with order blocks, rejection of the bottom of the order block, rejection of the top of the order block, or rejection of some kind of major moving average or some key point within the order block are all valid signals, because really any decent signal that comes to me in an order block, to me, is an edge, because they're very, very strong. Clearly, they don't always work. Clearly, I wish they did, but they work enough, right? So on the day that I took the trade here on the 2nd of April at 373.44. Two things are going on in this particular bar. The previous day we closed in the order block, and the day that I took the trade, we closed above the order block. That is a rejection of the high of the order block. By itself, that is a legitimate entry. Sorry, this has moved up so much, it's hard to get the right context here. Okay, here we go. So the previous day we closed in the order block, then we closed above the order block. By itself, that is a legitimate trade. In addition to that, on the day that I took the trade, we have what is called a higher low V1. And I use entry signals called V1s and V2s. And by the way, if you'd like to learn more about V1s or V2s, just go to my YouTube channel. Have a video there explaining all the details of V1s and V2s. But this was a V1. V1 consists of two bars, bar 1, bar 2. And the requirement is we need bar 2 to go under bar 1's low, which it did, and then we need bar 2 to close above bar 1's close. That it did. So this is a higher low V1. So why is it called a higher low? Well, this low here on the V1 is higher than the previous low. So it's a higher low V1, which by itself is a signal, but it also rejected the top of the order block, meaning previous day it closed in and then we closed above. So I entered here at 373.44 on the 2nd of April. I position size. I place my emergency stop 2 ATRs below like I always do. Now on this particular trade, my stop, because I want to keep my stop close to my entry price, when I trade a V1 or a V2, the number 2 bar is called the washout bar. And the number 2 bar, the halfway of the number 2 bar, there is going to be some inherent Fibonacci support. So I look at the low and I look at the high, and you see how I put the red line here right in the middle? So that is, we know I have my emergency stop down here, but my end of bar stop is simply a close below halfway of this washout bar, 369.19. All right, so rejection of the high of the order block, higher low V1, position size, emergency stop 2 ATRs below, end of bar stop, close below halfway of the washout bar, 369.16. Place my 1.5 ATR stop level above me, and here we go. Next day, didn't do a thing. Next day, down, was under my stop during the day, but again, I make all my buying and selling decisions except for my emergency stop at the end of the day, and it closed above, keeping me in the trade. Thankfully, the next day it gapped up massively. I hit 3 profit targets into that move. So I took 3 profit targets into that strength right there at the open. Additionally, on this particular day when it gapped up, it got right to my trailing stop level. Now I'm in trailing stop mode. Doesn't mean I do anything. It just means now in the future, if I have a close below a previous bar's low, I'm going to get out of half. Okay, next day down was under the previous bar's low, but barely closed above, keeping me in the trade. Also rejected my end of bar stop. The halfway of the washout bar closed above, kept me in the trade. The next day down, thankfully, keeping me in the trade. Next day up huge. Sold multiple profit targets into that strength. Next day up again. Multiple profit targets into that strength. Next day up massive. 3 profit targets into that strength. Next day up again. More profit targets. And then the high of the day today, I hit another profit target up here. So look, we are at 71.70 right now in the RSI. If Monday it closes below 70, I'm going to sell half, right? Additionally, are we above 65 RSI? We certainly are. 7170 is above 65 RSI. Whenever I'm at 65 RSI, if I have a close below the 5 EMA, I'm going to get out of half. So come Monday, if it continues to go up, what am I going to do? I'm just going to continue to take partial profits. If it closes below 70 RSI, what am I going to do? I'm going to take half. If that happens and I take half and then we have a close below previous bar's low, that's it for the trade. If Monday it just goes down and closes below the 5 EMA, completely out. So the key is I know exactly what I'm going to do with this trade regardless of what it does. If it does nothing, I know what to do. If it goes up, I know what to do. If it goes down, I know what to do. But I would really recommend that you get yourself a trading process that just tells you exactly what to do. I mean, it has to be based upon good trading principles, good risk to reward ratios, overhead resistance levels, so forth. But it's so much easier if you have a good trading process just to let it tell you what to do so you don't have to make impulsive decisions. Impulsive decisions are the worst. So this particular trade, monster, again, this particular trade, the remaining shares up 11.57%. XLV. Okay, XLV, combination of rejection of a major moving average and rejection of the high of the order block. I got in here on the 6th of April at 146.31. Why? Well, we have an order block, swing low, swing high, lower swing low, market structure change. I want to buy dips. I bought dip. I bought this dip that rejected the high of the order block and also rejected the 200-day moving average. I got in at 146.19. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 200, of which I entered very close to it anyway, so it's a good risk to reward ratio. I placed my 1.5 ATR trailing stop level above. Next day, gaps up, hit a profit target. Then it reversed very strongly, but then by the end of the day, it closed above the 200, kept me in the trade. The next day, massive day up for XLV. I hit multiple profit targets into this day, and I also got to trailing stop level. Again, I don't do anything. It just means now in the future, if I have a close below previous bar's low, I'm going to exit half the position. The next day, didn't do much. The next day, we did have a close below a previous bar's low after reaching trailing stop level. What did I do? I took off half of the position. Those are the rules. Oh, I deleted that. For a gain of 0.73%. Okay, fine. The next day we came down. Where did we bounce? Again, right at the 200-day moving average and closed up on the day. The next day near the highs, I took a profit target, sold into that strength. The next day was down. Thursday was down. Had this closed below the 200-day, that would have been it for the trade, but it held the 200, kept me in the trade, and today, nice big move up where I hit two profit targets into the strength. So this particular trade, the remaining shares I have on this particular trade are up 1.67%. Come Monday, if it continues to go up, I'll take partial profits. Monday, if it goes down but stays above the 200, I'll keep it. Monday closes under the 200. What do? I have to get out of the trade. So the remaining shares here on XLV up 1.67%. Alibaba. Really good example on Alibaba. You can see order block. Order blocks are a big part of what I do. This is an order block from the past. Again, I look at order blocks as smart money areas. An order block just means in the past that it came down here and then moved up. And so making that order block smart money so that in the future, if we get back to the smart money again, that's where I'm going to be looking to buy. And that's exactly what I did here on the 7th of April when I entered at 120.10. Two reasons I entered. The first was a rejection of the high of the order block. You can clearly see we came into the order block, closed back above it. Okay, we checked one box, rejected the high of the order block, but I like to have confluences. The second entry signal on this particular day was an RSI signal. During the day, we went below the 30 RSI, and then we closed above the 30 RSI. That is a deep dip buy entry signal. Rejection of the 30 RSI. By itself, valid. Rejection of the high of the order block, by itself, valid. Two of those together at the same time, confluence, much stronger trade. So that's why I took the trade. Rejection of the high of the order block, at the same time, rejection of the 30 RSI. Okay, I got in at 120.10. I placed my emergency stop 2 ATRs below. Now, question here is, where is my end of bar stop? Is it a close back below the order block? Could be, but I took this trade because during the day it went under the 30 RSI and closed back above. So therefore, my end of bar stop was in the future, a close back below the 30 RSI, which fortunately never did. Okay, so as soon as I entered, emergency stop 2 ATRs below, end of bar stop, close back below 30 RSI. I placed my 1.5 ATR trailing stop level above. Next day, took off like a rocket ship. It's amazing how many times when you take those signals where you have the confluences, the next day it goes up. It happens more times than it doesn't. On this particular day, in addition to massive number of profit targets at the open, I also got to trailing stop level, which again just means if I have a close below previous bar's low, I'm going to get out of half. Next day, hit another profit target into the strength. Next day, hit another profit target near the high. Next day, up a little, not enough for a profit target, but the key thing is we closed above this previous bar's low. Had we not, and closed below, I would have had to get out of half. Next day, up again, massive profit targets. Next day, up again, another profit target. Thursday, up huge, multiple profit targets. And then today, another profit target as well. Now, we are at 63.69. We closed off the high of the day. And the reason that I mentioned this is at the high of the day, we were at 65 RSI. So now this 5 EMA is coming into play in the future now, no matter what, because today got to 65 at the high. If I have a close below this 5 EMA, I am out of the trade. Alternatively, if it goes up and continues to go up, I'll continue to take profit targets. But if it rejects the 70 RSI, then I'm going to sell half. And then after that, the first time I have a close below previous bar's low, I'm going to get out. So this trade was a monster trade with starting with an extremely good risk to reward ratio. This is up 14.8%. And you can see the day that I bought was the bottom. The rejection of the order block and the rejection of the 30 RSI, that was the bottom, right? So, these confluences are really, really helpful. They're really strong. They don't work all the time, but these things don't surprise me anymore. So, I've been trading for over 30 years and I see this over and over. They don't always work for sure, but sometimes they work spectacularly like they did here. And again, the remaining shares on Alibaba up 14.8%. UNG. All right. Well, we talked about abandoned babies before. Let's talk about something called a island reversal. An island reversal is very similar to an abandoned baby. It's the same concept. It's just that abandoned babies are one bar. They have a gap down and a gap up. So you have that one abandoned baby. That's why they call it an abandoned baby. It's like a little bar there left by itself abandoned. Well, there's also things called island reversal bars. Island reversal bars are the same thing as babies, except they consist of two or more bars where a baby consists of one. So let me show you here. So you can see these three bars here in the green. The day before that, we gapped down, right? So very bearish. Then we moved sideways and then followed by a huge gap up, leaving these three bars by themselves, like a abandoned baby, but there's more than one, so it's an island reversal. Okay, so that happened, went skyrocketing up. But here's the key. When you have an abandoned baby or you have an island reversal, the high of that island reversal or the high of that baby is a very important, strong support level. So if you watched the podcast last week, I was waiting for UNG to come down and reject the high of this abandoned baby back here on the 14th, and that is this dotted line here. So I've been waiting and waiting and waiting and waiting and waiting for the price to come back down and reject this level. Well, that happened on Wednesday. You can see we went below and then we closed above. So I took the trade. Now, abandoned babies, island reversals, the way that I manage these trades, 2 ATR stop. If I'm wrong, 4 ATR profit target. If I'm right, if I'm wrong, I lose 1% on my account. If I'm right, I make 2% on my account. I set it and forget it. I have a limit order. One cancels another order. If it hits this one, it cancels that. If it hits that one, it cancels this, right? So, it's a good risk to reward ratio. It's a 2-to-1 risk to reward ratio. And I just know from experience that more times than not, I'm going to make 2% than lose 1%. So pretty good. So I've only been in this trade for a couple days, but it has bounced so far, and this particular trade up 2.58%. So pretty good start to the trade. All right. I did place a trade today on the Dow, DIA, and it's a short trade. So I usually talk about bullish order blocks, which are green, and you can see down here, look where the price came down to the green order block and bounced. So the bullish order block worked fantastic. But we also have bearish order blocks. In bearish order blocks, I have the reverse situation. I have a swing high, followed by a swing low, followed by a higher swing high, followed by market structure change to the downside. And if it's a bearish abandoned baby, swing high, swing low, higher swing high, market structure change to the downside. Now the highest up closing bar I take into the future, and that is the area that I want to look to short. This was not a smart money area to buy, clearly. The market went down from that. So now we are back in the unsmart area. Now, the market is very strong. Can it blow through this? 100% it can blow through that. But we are back at a level where before was not smart money. So why did I enter today? Greg, it didn't reject the bottom of the order block. It didn't reject the high of the order block. No, it did not. But it rejected the 70 RSI. Do you remember on Alibaba where we rejected the 30 RSI in the bullish order block and it took off? It's the same concept, it's just reverse. Now, today we rejected the 70 RSI in a bearish order block. All right, so you can see the RSI is 68.51, but during the day at the high, it was over 70. So that is a rejection of the 70 RSI. So I entered today 494.27. High position size. I placed my emergency stop 2 ATRs above, of course, as always. If it gets up there, how much do I lose? 1% of my account. Where's my end of bar stop? My end of bar stop is simply a close back over the 70 RSI. Right now we're at 68.51, so it's not going to take it a lot of upside move to close above 70. So I have a good risk to reward ratio, right? Certainly, look, market's super bullish. So why am I taking a short? Well, same reason I was buying at the bottom when the market was bearish, because it's in certain levels. So going forward with this trade, Monday, if this closes over 70 RSI, I don't care if it closes at 70, that I'll keep it. But if it closes above 70 RSI, I'm out of the trade. Now, to the downside, I placed my 1.5 ATR trailing stop level below me because I'm short. If it moves down, I will take partial profit. So this trade, brand new trade today, completely even on the trade, but nice that I can show you, kind of the other side of the coin, not just longs, but this is legitimate short setup. I don't know if it's going to work, but the way I've structured it is if I'm wrong, very likely I'll be wrong small. And if I'm right, I could have potential for a big move down. All right. So just to recap, AMD, remaining shares up 29.48%. Silver, remaining shares up 5.2%. Microsoft, remaining shares up 11.57%. XLV, remaining shares up 1.67. Alibaba, remaining shares up 14.8. UNG, remaining shares up 2.58. And DIA, brand new trade. So huge week, huge, absolute huge week, but I'm really glad to see my indicators, my setups really worked well. Now, I did have to exit 3 of my trades this week for a loss, but small losses, right? We're always going to have losses, but the key is you just have to keep them small, and they were small. So let's talk about what they were, and let's start with TLT. All right, so I entered TLT here on the 13th of April at 86.75. So why did I take this trade? This is another strategy that I use called a higher low V1, V2. And let me bring your attention to these 2 green lines. These 2 green lines, anywhere beneath this top line, anywhere above this top line, is considered the value zone. In general, I want to buy below value and sell in value, or I want to buy in value and sell above value. What I do not do is I don't buy above value. I don't buy above this green line ever. And most retail traders get in the habit of buying when things are moving up here. That's, for me, it's a no-go area. I want to buy below value, sell in value, or buy in value, sell above value. So the reason I'm pointing out the top green line and the bottom green line, the value zone, is that we closed below the value zone. We came into the value zone. We had a pullback, and then we created a V1. Remember, a V1, 2 bars, bar 1, bar 2. Bar 2 goes under bar 1's low, closes above bar 1's close. There you go. That's a higher low V1. All right. So That's why I entered the trade. I entered at 86.75. I placed my emergency stop 2 ATRs below my end of bar stop. Remember, on a V1 or a V2, your end of bar stop is a close below halfway of the washout bar, the number 2 bar. That is here at 86.52. So I entered the trade. Next day, started off great. At least I took a profit target before it reversed, right? So it helped mitigate the loss. Next day, nothing burger. But then Thursday, we closed below halfway the washout bar, the 86.52. And so that told me I had to get out. And I did have to get out for a loss of 0.57%. Okay. And then today, it went right back up. What do you do, right? That's just trading. And this happened to me multiple times this week where I hit a stop and I had to get out. But it's just part of trading, right? It's going to happen to every single trader. But if I got out and then it continued down, 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 I was really glad that I got out. But there's no way around this. It's just going to happen, and you just kind of have to take your medicine, right? And you have to follow your rules. So I did get out of the trade, even though it rocket back up today, but it's fine, for a loss, but a small loss of 0.57%. Verizon. All right. Verizon. I took Verizon here on the 14th of April at 45.40. Why? Because it rejected the bottom of the order block. During the day, it was below it. Then it closed back in it. That was my trade. Got in 45.40. Position size correctly. Placed my emergency stop 2 ATRs below. Next day, what happened? It closed below the order block. That was my stop. I did have to take a loss of 0.82%. And then what happened? Thursday, rocket ship up. So I was right as far as the general idea of where I was buying, but I was wrong on the timing. Now, could I have gotten in the very next day? I could have, but now it's moved up so much. A lot of the risk to reward's not there. Here, the risk to reward was good, and it was. I was wrong, but I was wrong very small. But here, if I bought it on Thursday, now my stop would be all the way back down here, way down, right? So anyway, had the right idea. The timing was wrong. That's just part of trading, and I did lose 0.82%. McDonald's, another one, exactly happened the same thing. But I do have some friends that are in this trade, so I'm glad they're doing well. But I did enter McDonald's here on the 13th of April at 304.30. Why? Rejection of the 300-day moving average, the orange line inside an order block. The next day, closed below. I had to get out of the trade. That's it. I got out of the trade. I had to take a loss of 0.36%. I'm sorry, 0.56%. Not a big loss, but I had to get out. But then what happened the next 3 days? Ripped higher, ripped higher, ripped higher. Could I have entered back in here the very next day? I could have, but I didn't because it was kind of far above the 300-day moving average. So I didn't enter in here. But that's just how it goes, right? So 3 losses, fairly small losses. Frustrating part is all 3 of them immediately reversed back up. But listen, I had some other great trades that were up double digits. So, you got to take the good with the bad. So, but the point is that the trades that were working, I stayed in and rode those up. The ones that weren't, I was very impatient with the loss. I mean, they were 2 of these positions. I was out the very next day. The other position I was out after 2 days. But that's how I trade. I'm out quickly when I'm wrong. I stay in when I'm right, and that's the correct way of trading. So just to recap on those 3 losses, TLT, loss of 0.57%, Verizon, loss 0.82%, and McDonald's, loss of 0.36%. So small losses, that's fine. So those are all the open and closed positions that I have. I hope that was helpful for you to take a look at. And I do have the potential trades that I'm looking at for next week, and I think I've got some good ones. But before we do that, I just want to spend a few minutes on trader psychology and then we'll get to the trades for next week. So this is from Lone Stock Trader. You can follow him at Lone Stock Trader over on Twitter. And what he wrote here, when I read this, I was like, that really is true. Like I deal with this with other traders that I know, and of course my students. But let's read what it has to say. The confidence required to follow your strategy just can't be taught, and neither can it be acquired through backtesting. It has to come from years of firsthand experience using it and going through its numerous ups and downs. Real confidence in your strategy has no shortcut. And I know this from my students. When I teach my students, I teach them order blocks and deep dip buys and the combination. But they don't, when I see these things, I'm very confident because I've seen hundreds of thousands of trades using this. So I know in the long run they work. But for them, this is something new. They don't know if it works or not. So they don't quite have the confidence. And I just mentioned this to a student last week. I said, look, you just get as, with the trades that you take over time, you will gain the confidence that this does work. But I can't teach you the confidence. This has to come through your own experience. And so I always suggest to students is, listen, every trade that's a good one, take it. Take it very small. This isn't about making money. This is just about you taking numerous trades and going, oh, you know what? That did work more than not. And then after that, you're more confident in it. You can size up. But just like Lone Stock Trader says, the confidence required to follow your strategy just can't be taught. And neither can it be acquired through backtesting. You can look at backtesting results, but you haven't lived it. You don't know it. You don't trust it. So the only way is it has to come from years of firsthand experience using it and going through its numerous ups and downs. Real confidence in your strategy has no shortcut. It's just reps, sets, and reps and experiences. But you got to get yourself a good trading process to begin with. So anyway, I hope this was helpful. Thank you, Lone Stock Trader. You can follow him at Lone Stock Trader. So all right. So I do have 8 potential setups that I'm looking for next week in these 8 different markets. Now, it is theoretically possible that all 8 of these could trigger on Monday, for example. But if I have 8 that trigger on Monday, it doesn't mean I'm going to take all 8. As a matter of fact, I'm only going to take one. I don't care how many triggers. I'm only going to take one. I only take the best signal of the day. I don't care if I had 100 signals that triggered. I would have to narrow it down to one. And how do I do that? Well, I give every setup a quality score. Just to be simple, if it has one signal, it gets a score of 1. If it has 2 signals, it gets a score of 2. I'm probably going to take the one that's a score of 2. If there's one that's a score of 5, probably going to take that one. But you also have to look at risk to reward as well. Maybe you have a score of 5, but the risk to reward is horrible. Now you got to back some points out of that, or maybe just even pass on the trade, even though it has so many signals, because risk to reward is super important. I also look at the longer term charts. If I'm trading the daily, looking to the weekly to see if there's any rejections of key levels on the weekly or any entry signals on the weekly that help support my case on the daily. I also look at relative strength. Maybe the market's down and there's 4 entry signals, but one of the 4, it was an up day. Well, that was strong on a down day. That gets extra bonus points. So this is I give everything a report card, and like I said, it's worked well for me for many, many years, just picking the best one of the day. And the best one of the day over time is going to have better results than the ones that were subpar, right? And if I can put a little plug in here for a minute, I do teach private lessons. I teach students all over the world. I teach a 20-hour one-on-one course. I think the best way to learn anything is one-on-one with your instructor or your teacher or your coach, and that's why I structure this way. And like I said, I have students all over the world, many different languages, right? And I teach them in this 20-hour course. I will teach you all of the different strategies that I use. I'll teach you step by step each single rule. We'll go over many, many, many trades, many examples, and it's very important to me that when my student is done with that 20-hour course, that he or she is a really good trader and knows the rules. And I promise you, if you become my student, I will give it 110%. I love to teach. I love to see the results of my students, especially when they start to understand things and then have good results themselves. So if you would like to be a student of mine, I'd love to have you as a student. Just send me an email. My email is in the link of this YouTube video. Just reach out, say, Greg, potentially interested in taking your course. I'll reply, say, great, fantastic. Let's set up a kind of get to know you call. It's not a sales call. I just want to learn more about you, your trading goals, your trading challenges, and it's a good time for you to ask me any questions about the course. But I promise you, it's not a sales call. You will never feel that pressure. But if you're interested, please send me an email. Love to talk to you and love to teach you everything that I know. And the one-on-one course is the best way to do it. As a second option, I have a really good online course available at udemy.com. The link's in the description. In that course, I teach you how to trade the deep dip buy stock trading strategy. It's a very extensive course. It's 9.5 hours of video. It's affordable. It's between $30 and $50, and I've sold so many of those around the world as well. So two really good options: 20-hour one-on-one course direct with me, one-on-one, and then as a second option, starting off with the Udemy course. And again, the link's in the description. So thank you for letting me put in my plug, and let's get into the potential trades for next week. All right, let's start with Adobe. So Adobe is not that close, but just kind of give you an idea. You can see we've created a new order block here. Why? Well, because we had a swing low here, and then we had a swing high here, and then we had a lower swing low here, and then Thursday we changed market structure to the upside. So once you change market structure to the upside, now I'm looking to buy dips, right? And I'm looking to buy dips back in this order block. This is the smart money area to buy dips. But could I take a rejection of the high of the order block? I could, but my stop would be a close below the low of the order block, so it's kind of far away. It's not a very good risk to reward ratio. There are no 200s, 250s, 300-day moving averages inside here. So when I have an order block that doesn't have anything inside, I look to make my own level. And my own level that I'm looking for is 227, this green line. Why this green line? Because if we look at these three bars, they're a V2. Bar 1, bar 2, bar 3. Bar 2 goes under bar 1's low. Bar 3 closes above bar 1's close. Remember, on V1s or V2s, where's the key level of support? Halfway of the washout bar. Halfway the washout bar is 227. So this is the level that I'm looking for on Adobe. Now, it's quite a long ways from there. I don't know if it's going to get there. Probably won't. But if it does, I like to have my charts already pre-marked up so I know where the key levels are. And like I said, very likely this won't get there. But if it does and it comes down and rejects that 227 level, that's a key level, halfway to the washout bar of V2, within a key level of the 200, of the order block. And then if it rejects the 227, my end of bar stop would be a close back below 227. But I have a lot of trades that I mark up and go, oh, that'd be perfect, but they don't get there. That's fine. Something that I do mark up will get there. It never fails. It will get there. But on Adobe, I'm looking for a pullback into the order block and a rejection of the 227 level. Berkshire Hathaway. All right, so we have an order block that it's been from the past that it's been dancing around. You can see it closed below the order block, closed above. Would have been a legitimate trade. Would have worked out pretty well. Actually, still be in the trade. But Thursday we went way below the order block and then we closed back in it. Was that a valid trade? 100%. That was a valid trade, and it's a V1. I have a good friend of mine that took that trade as well. Started off good today, reversed back down. So what am I looking for at this moment? Really what I'm looking for is another retest of the bottom of the order block. So maybe Monday, if we go below the order block and then close back above the order block with a good risk to reward ratio, not that 2 days ago was a bad risk to reward ratio, that was plenty good. But I just, I didn't take it on this particular day. So, Berkshire Hathaway has not rallied like the rest of the market, but we are at a key level. I just didn't like the action. I could have bought it today, actually, because it's still above the order block, but I didn't like the reverse V1 to the downside. So, in a perfect world, next week, maybe we go under the order block, close back above it, with the confluence of a V1, something like that. So that's what I'm looking for. Another retest at the bottom of the order block. Looks like the bottom of the order block is about 473. If I do take it with rejection of the order block, bottom of the order block, any close below 473, I'd be out of the trade. Netflix. Netflix been good to us. Good to me. I took Netflix here, if you can believe that, all the way back here on the 18th of February. Under 30, over 30, rejection of the long-term trend line. Rode it all the way up to wherever it was. No. Now I remember. No. I had to get out here before earnings, and then it took off. But still, double-digit trade. It was really nice. And then it rallied up, and then it came back down. We had a big rally. But now, look what happened today. Down 9.72%. Why? I have no idea. I guess it was news related for sure. Doesn't matter. I'm looking for potentially to get into Netflix. Why? Well, we have an order block here. We have a swing low and a swing high and a swing low and a swing high, lower swing low, market structure change, lowest closing bar prior to market structure change, bring it here. So look, when you're up here, way up here, like 108, and you look back to when the order block was formed, like 92, is it safe to say that smart money was buying back here? Well, yeah, obviously it was. It went from basically 90 to 110, 19. So yeah, smart money was buying here. So I bring the smart money area into the future. Is it going to be smart money again this time? Not necessarily. Things can change. Just because it was doesn't mean it will be. But I can tell you that more times than not, what was smart money is smart money again. But not every single time. We'll see. So what I'm looking for on Netflix is I'm looking for a rejection of the 50-day moving average. This is the gray line. The gray line, the 50-day moving average right now is 91.95. We're at 97.31. So we're quite a long ways away from that. I would also take the 100-day moving average as well. That's the red line. 92.52 is the 100, 91.95 is the 50. Basically any rejection in an order block, any moving average rejection order block, I would consider taking for sure. So I don't know if it's going to get here. It may not get there, but if it does, now that 100-day moving average of 92.52 or the 50-day moving average of 91.95, those are my two key levels looking for rejection. I want to see the market come down, test them, run and have no sellers underneath them and close back above them. It gives me a good piece of intelligence to go, oh, there were no sellers under there. So I may consider taking the trade as long as I have good risk to reward ratio. So I'm looking for a pullback to either the 100-day moving average and rejection of the 100-day moving average 92.52 or a rejection of the 50-day moving average 91.95. If I take either of those and they reject them, I would then get out. My end of bar stop would be if it closed back below one of those moving averages. So, big, huge move up on Netflix. So, could be an opportunity here. We'll see. Nike. Well, Nike has rallied a little bit, nothing like the rest of the market, but Nike was so low. But look, we did all these days, we closed under the order block, and today we closed in the order block. So could I have taken that trade? Yeah, I could have. And my stop would have been a close below the order block. But why didn't I take the trade? I didn't take the trade, everyone, because it took 1, 2, 3, 4 straight up days to get here. The rubber band's pulled a little tight on this. I could be wrong. It could just go straight up and I missed the trade. So what I would like to see on Nike is I would like to see it close below the order block for a day or two, and then again close back up in the order block. That would give us a higher low close back in the order block. Here we came from a lower low closed in the order block, which is valid. It's just not as good as a higher low close in the order block. And again, we've moved a long way to get to that order block, so a bit of a pullback would not be surprising. So what I'm looking for is a close back under the order block and then another close back in the order block, making it a higher low close back in the order block. My stop would then be a close below the order block, which it looks like it's about 45.75. So that's what I'm looking for on Nike. USO is oil. Well, oil got hammered today. Of course, oil ran way, way, way up on all the Middle East conflict. And now that that seems to be settling down, we have had a huge pullback, but we are back into an order block. So what are my key levels in the order block? Well, there is what I'm looking for right now is, you see this dotted line here? This is a moving average. It's not the 50-day moving average, it's the 50-day. It's not the 50-day SMA, it is the 50-day EMA. And so this is the only major move. This is the only moving average inside this order block. So I can use any moving average that I want, and this is the one that's in there. The 50 EMA right now is at 122.35. No, excuse me. Look at the wrong one. Here we go. 109.24, the 50-day EMA. Right? Yeah, 109.24. We're at 116.04. So it still would have to come down a ways, but if we do come down and reject the 109.24 level and reject it and close back above it, I would definitely consider that trade. It's a rejection of a key moving average inside a key area. Key level within key level. Now, could I have taken this trade today with a rejection on the high of the order block? I could, but my stop would basically most likely be a close back under the low of the order block. That's not a good starting risk to reward ratio. So maybe oil goes up from here and I miss the whole thing. That's fine. But again, I'm looking for rejection of the 50-day EMA, which is currently 109.24. If it does reject that and I take that, my stop would be a close back below 109.24. VIX. All right, VIX. You know, I've had some really good trades on VIX in the past with order blocks, and clearly, you know, last month VIX just rallied like crazy because of what was going on in the Middle East, right? Well, now that the market's rallied, VIX, not surprisingly, has come back down. But we are coming to a key level. We're coming to an order block. This order block was formed all the way here on 225. And again, swing low, swing high, lower swing low, market structure change. When we're way up here, almost $40 with smart money buying at 27. Yeah, clearly they were. But now we are coming back to that smart money area. Does it mean it's smart money area again? No, for sure, no. But the market stretched. Fixes got crushed to the downside. Would it be surprising to anybody if the market came down for a while? That would surprise me. If that happens, what's going to happen to VIX? VIX very likely will go up. So I'm looking for, now this is a very narrow order block. I'm looking for a rejection of the high of the order block or a rejection of the low of the order block. Doesn't mean it's going to work. It just means that if I'm wrong, I'm probably going to be wrong small. And if I'm right, I have the ability for big move up. So the high of the order block, I'm looking for a rejection of 2806. The low of the order block's a rejection of 2737. So it's very, very tight. So rejection of either 2737 or rejection of rejection of 2806 or rejection of 2837, the high and the low of this order block, I definitely would consider getting back into VIX to the long side. If I do take a rejection of the high of the order block, my stop would be close below the low of the order block. If I take a rejection of the low of the order block, my close would be a close below the low of the order block. I don't have them on my charts anymore, but back in This level here was a previous order block, and that was the place to buy, and it really did take off. This order block is not as low as this order block, but it is the most current order block close to the price where we're at. So I'm going to be watching VIX closely here next week. XLU utilities. All right, well, we have an order block here on 3/20/26. We had a swing low, we had a swing high, we had a lower swing low. We broke above that first swing high, defining our order block here, lowest closing bar. Okay, what am I looking for? Well, it did reject the 50-day moving average today. Was that legitimate? Yeah, I didn't take it. But really what I'm looking for that I feel more comfortable with because it's lower is this 100-day moving average inside of the order block. Again, key level within key level. The 100-day moving average is 44.64. We're at 46.16. So maybe it doesn't get there next week. I have no idea. But if it does, I want to have these pre-marked up so I don't have to think about it. I just go, oh yeah, I marked that up. That's the level. So if we reject 44.64 next week, I would consider getting long XLU. My stop would be a close back below the 100-day moving average of 44.64. Last but not least, Exxon. All right, so Exxon really has sold off dramatically with the rally in the market. Of course, it's all oil related, but there is a order block here from the past that we're getting pretty close to, and in the green box. And then what lives inside this order block? Red 100-day moving average, 138.92. We're at 146.44 at the moment. Not there yet, but look, this is a substantial sell-off. We're coming into a previous smart money area order block, and we have the main thing is we have this moving average here. That's our line in the sand. And what do I mean by line in the sand? Line in the sand just means if it rejects it, goes below it, closes back above it, I take the trade. If it closes back underneath it, I'm out. So as long as it stays above, I'm in. As long as it closes below, I'm out. But it's a key level, 100-day moving average key level within a key level order block as well. So that's what I'm looking for. So just to be clear, looking for a rejection of 138.92 next week on XOM, on Exxon, and then if it closes back below 138.92, I would exit the trade. So anyway, there you go, everybody. I hope you found this helpful. If you have any comments or questions, please leave them in the comment section. I'll do my best to get back to you. Have my first baseball game of the season this week, so I'm excited. I'm like twice as old as anyone on that team, but I'm old and slow, but I'm just glad that I'm out there with the young guys playing baseball. So wish me luck tomorrow. I always like to leave off with, listen, if you have the opportunity to do something nice for someone or act of kindness, just do it. Man, this world needs it, doesn't it? I mean, we like it when out of the blue somebody does something nice for us. Feels good. It's nice. Well, why not pass it along and do it for someone else too? So, I mean, if you run across a situation where you can help somebody out, help them out, right? It's good for them. It's good for you. If you also have the opportunity, if you run across an animal that is in need of help or could use your assistance, do it, right? I'm a big animal lover, but they appreciate acts of kindness just like we do. So, in this world, I think we could have some improvement on people being nice and helpful towards each other. So maybe just let it start with us. I know I have this very small platform, but I like to try to leave off with something positive. So listen, if I can help you with anything, let me know. I'd love to be your teacher and your mentor in the 20-hour course. Just send me an email. I also do private consulting with different people. So if you have any special customized trading needs, you can reach out to me as well. But whatever you need help with trading, I can help you, and I'll do my best. All right. Thank you, everybody. And God willing, I will see you next week. And enjoy the rest of your weekend. Take care. Have a good day. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.